I think you can really attribute the performance to three elements. The first is people, the second is strategic clarity, and the third is experience and delivery.
Hello, you're watching Proactive. I'm joined by Cordiant Digital Infrastructure Joint Managing Directors Benn Mikula and Stephen Marshall, as well as Chief Financial Officer Mark Tyner. Welcome all. Thank you very much for coming into the studio today.
Thank you for having us.
So, Steve, I'm going to start with you. How would you summarise the results?
Well, actually, the first 6 months of this financial year have been really quite extraordinary results. We've grown the NAV by 5.4%. Increasing the NAV to 124.4 pence. We're also confirming this morning that we will pay an interim dividend of 2.1 pence, which is 4.7 times covered by EBITDA or 1.8 times covered by AFFO. So really extraordinary results driven by really good quality growth in revenues and EBITDA by our primary three operating companies, CRA, Emitel and Speed Fibre Group, with some improving trends in our Hicks data center in New York.
Mark, could you explain the drivers of that performance in more detail?
Yeah, so the strength of these results is really driven by a strong EBITDA growth performance across the portfolio. And for the 6 months across the whole portfolio, EBITDA grew 15.2%, which we think is a very good result. Down at the platform level, at Emitel, EBITDA growth of 15.7% was driven by new contracts, 2 new broadcasting contracts signed at the beginning of the period, plus the effect of last year's inflation coming through in this year's revenues. At CRA, EBITDA grew 16.5%, a very strong performance. And this was driven not only by the inflation feeding through from the previous year in those contracts that are linked to it, but also the really strong performance of Cloud 4Com, the cloud business that CRA acquired in January 2024. And finally, at Speed Fibre, EBITDA growth of 7.2%, a pretty good performance for the first half of the year. We're very pleased with that.
Ben, let me bring you in here. What do you think has underpinned Cord's performance this time, but also since the company was listed?
I think you can really attribute the performance to three elements. The first is people, the second is strategic clarity, and the third is experience and delivery. And let me unpack those in sequence. As regards people, we have a team of almost 20 digital professionals within the wider firm. And these digital professionals are composed equally of people with deep operating experience, such as Steve, who ran the largest digital infrastructure company on the planet, as well as experienced private capital professionals. And that makes for a very harmonious and balanced and actually quite large team. The second is strategic clarity. These are critical assets, and we bring to bear a buy, build, and grow model, which we have delivered quarter after quarter and done so with success, as the numbers bear out. And finally, we have experience in delivery, and that loops back to the people. With this balanced team and the deep operating expertise, we are able to help companies become better, conduct bolt-on acquisitions, operate within capital discipline, and import best company practice from the largest names in the industry. And taken together, I think that's a really compelling offering that should continue to perform for the quarters to come.
Steve, can you explain the thinking behind the capital allocation policy at Cord? You mentioned that well-covered dividend, which you continue to pay, but you're also looking to invest in growth as well as buy back shares at the current share price.
Well, we need to be extremely careful with capital allocation policy. We've done that from the get-go in respect of recognising that interest rates were really quite low in the early days, and they would more than likely increase over a period of time. So we wanted good cash flowing, good growth assets in our investment portfolio, which we did. And I think we were very fortunate to be able to acquire those really superb assets in Poland, the Czech Republic, and Ireland. Since then, of course, we've continued to look at whether we should buy back our stock, and we have done some of that in terms of owning more of the assets that we enjoy and benefit from. But also, I think a lot of our shareholders also want a good progressive dividend. So we have been extremely careful to grow and try to grow the dividend at a faster rate than we set out at the IPO. and the dividend that we provided last year and we continue to offer this year is ahead of what we were projecting in the IPO at the time of the launch, and that has been growing at a very nice rate, and we have great assets with great growing revenue streams, and we would expect to continue to offer a progressive dividend policy in the future.
We've all seen over our careers, which are long careers at this point in this sector, what happens when you have good assets with bad balance sheets, and we're very, very careful on that front.
Okay. And you say your confidence for the year as a whole, Ben. Could you give us a little more detail on what gives you that confidence?
If you look ahead, there are two factors that intersect. The first is we are benefiting from some strong market trends. You can't pick a paper up these days without reading about artificial intelligence, and in our daily lives we see the increasing presence, indeed omnipresence, of digitization. Without our infrastructure, without this critical plumbing of the internet, none of that would work. We are beneficiaries of that. But the second thing, and I think this speaks to the efforts of Steve and my other colleagues, the platforms we have acquired are operating at a very high level. These are good quality assets with excellent management teams. We work closely with them, and they are delivering good results today, and we have every expectation they will continue to do so in the future.
And I think, when we look beyond this year as well, these assets are extremely well placed to continue to deliver really good growing revenues and EBITDA. When we look at the sort of investments that the underlying assets and management teams are making, they will grow those revenues. Examples of investing in DAB, digital audio broadband radio, in both the Czech Republic and Poland, investing potentially in an expansion of the data center network, and leasing up more and more capacity that we have across the broadcast network. And the mobile operators want more and more access to our sites to add more antennas, more technology to those sites. So very, very good long-term contracts with growing, with escalation clauses, with additional revenues coming on to those contracts and those assets, really do drive a very sustainable growing cash flow, which makes these assets and this industry extremely attractive to investors.
Well, gents, congratulations again on today's results. Thank you very much for coming into the studio.
Thank you.
Thank you.
Thank you very much.
That's Cordiant Digital Infrastructure Joint Managing Directors Benn Mikula and Stephen Marshall, as well as Chief Financial Officer Mark Tyner.